Every day, the world moves on as it always has. Cities wake up, work begins, and life feels familiar. But beneath that sense of normality, something is shifting. The climate is changing, and the systems we rely on, energy, food, water, cities, finance, are under pressure in ways we're only beginning to understand. These changes don't live in reports or projections, they are already shaping people, livelihoods, and communities. We created the Climate Leadership Podcast so these challenges don't remain abstract or distant, but are explored through the people working inside these systems, making real decisions with real consequences, often without clear answers. This is not a space for fear, blame, or perfection. It's a space for honest conversations about what leadership looks like in a changing world. If you're listening, you're already part of that leadership. Let's begin the conversation.
Welcome to another episode of the Climate Leadership Podcast, where we explore the real systems, trade-offs, and leadership choices behind climate action. This podcast is about moving beyond high-level ambition and simplified narratives to understand how climate challenges are actually navigated in practice across businesses, investment, governance, and organizational decision-making. Today's episode focuses on climate and nature risk in credit markets, an area where environmental risk can show up before regulation catches up, and where financial decisions are increasingly influenced by climate and nature considerations. Rather than treating climate or biodiversity solely as an ESG matrix, we are exploring how these risks impact creditworthiness, default risk, and decision making across asset classes. My guest today is Mr. David McNeil, Climate and Nature Strategy Lead at PGIM, where he supports ESG integration and research across fixed income, equity, real estate, private credit, infrastructure, and agriculture investing. David is an environmental economist with over 13 years of experience helping organizations integrate natural capital into investment decision making. His work sits at the intersection of climate science, finance, and risk analysis, helping investors understand and act on environmental risk before they materialize financially. In this conversation, we move beyond high-level concepts to discuss how climate and nature risk affect credit markets, why lenders must act fast than equity markets, examples of environmental risk cascading into financial stress, and what boards and CFOs should be asking their credit teams today. Thank you, David, for joining me today, and it's wonderful having you here.
Thanks for having me, Amber.
Yeah, so as we start our conversation, can you please introduce yourself for our audience?
Yeah, certainly. So as you introduced, I'm the Vice President of Climate Strategy at PGIM. So we're Prudential Financial's asset management arm. And we manage $1.5 trillion of assets under management across quite a wide range of asset classes, so some of the ones that you mentioned. My background, as you alluded to, is in ESG investing, but I've also had experience across environmental data and research and environmental policy developments for public sector institutions. So quite a number of years experience in this space has obviously evolved over time. And it's been interesting to see your client needs evolve over the recent years.
Okay, wonderful. So as we begin our conversation, I would like to understand if you can define what credit markets are and what equity markets are.
Yeah, certainly. So when we're talking about credit markets, we're typically talking about companies issuing debts to investors as a tradable instrument. So that does help them fund their operations, fund projects, but it doesn't come with any ownership rights on the company. And essentially all the tying themselves to there is repaying debt to investors plus interest payments. So from an investor perspective, the focus there is really just on minimizing the downside risks, so the probability of default of that company where you wouldn't be repaid. On the equity side of things, this is obviously companies issuing stock or ownership shares in a company to investors. So sometimes that ownership also comes with voting rights. And the aim here for investors is to try and have growth in the value of that equity over time. So you can see here the drivers are actually quite different. On the debt side, the credit side is very much around minimizing downside risk. On the equity side, there's actually a lot of opportunities for upside as well.
Okay, right. So can you start by explaining what climate and nature risks look like in credit markets, and why it's increasingly becoming a material concern for lenders and investors.
Yeah, certainly. So in credit markets, I tend to frame this for climate and nature risk quite simply. Some core questions: does this change cash flows? Does it change volatility for companies, or does it change the overall downside risk profile? And
Mhm.
as I've alluded to, credit risk is asymmetric, so you don't necessarily get paid more if things go well for a company, but you do lose real money if things go badly and you have defaults. So anything that increases the probability or the severity of some of those downside outcomes can really become quite financially material very quickly. What's changed with regards to climate and nature is that these risks are no longer abstract or long dated. There was a perception in the past that these were issues long in the future. We're already seeing some sectors, some operating locations, seeing higher insurance costs, higher capital investment requirements, operational disruption. And we do think over time this could lead to higher refinancing costs for companies as they issue new debt. So what we typically see is once some of those factors start to move, credit markets will respond. And this will typically happen before formal regulation from governments catches up. So we've
Mhm.
seen some examples of this in the utility space, some large wildfire events in recent years, for example, on the municipal, the government debt space with water risk in some regions. And
Mhm.
water risk in particular is an area that's moving from what was historically quite a marginal consideration for many companies to actually quite a material source of credit risk in certain sectors and certain regions.
Okay. So, why do you think credit markets experience climate and nature risk earlier than equity market? And what makes these risks particularly challenging to assess in lending decisions?
Yeah, I wouldn't say they experience it earlier, but they do experience it differently. And a lot of this comes down to the structuring and the timing of some of these risks. So credit obviously has fixed maturities, bonds have covenants, and companies have refinancing needs at different points over time as their bonds mature. So if climate and nature risks coincide with some of those moments, for example, through higher costs, lower revenues, or challenges in insurability of assets, they can become material sources of risk, which investors naturally will want to be compensated for through higher
Mhm.
interest payments. Now, moving to equity, equity does act as a cushion for credit investors because it's lower in the capital stack.
Mhm.
So typically you'll see examples of ESG controversies, so human rights violations, other wider ESG controversies in supply chains, for example, having in some cases quite significant impact on equity valuations, but little to no measurable impact on credit spreads. So
Mhm.
on the equity side, we see much more of a focus from an ESG lens on reputational risks in many cases and intangible aspects of company value. Equity investors naturally can take a longer term view. They can absorb some of this volatility in the pursuit of longer term upside opportunities. But credit investors usually can't, so they'll focus typically on asset values over a defined period, say if they have a 3 year or 5 year bond that they hold, and they
Mhm.
see limited upside there in many cases and very real downside.
Okay. So, how do environmental risk like climate events or biodiversity loss translate into creditworthiness or default risk? Can you give example of where these risks have already affected financial outcomes?
Yeah, so it's helpful to think of these risks in terms of transmission channels into credit risk and default risk. So physical climate risk, for example, extreme weather events, floods, droughts, hurricanes, wildfires, all of these can reduce revenues for companies through downtime, disruption to supply chains, or increase their costs via insurance and repair costs. So for many companies, it's common to see business disruption from physical climate risks actually having a higher impact than direct damage to their owned or leased assets. The interruption effect is stronger. So transition risks on the other side can actually show up through higher operating costs, stranded assets, so assets that prove unviable because of tightening regulation,
Mhm.
or litigation risks, or shifting demand for products and services as a result of changing regulations. Nature risks quite often come up through dependencies on nature, and here water is a good example where many companies have critical dependencies on access to fresh water for their operations, for their products and services. And water, increasingly, we're seeing through what we call license to operate risks, where there's community opposition to new projects. We see this increasingly in the data center space, where a lot of community opposition to new projects is coming through from the point of view of water availability and concerns there. And what matters for credit here is whether these pressures weaken margins for companies or the free cash flow, whether they increase the leverage, the debt that companies need to take out, whether they impair collateral or constrain their refinancing options. And when these happen, you start to see it in credit spreads, you start to see it in ratings pressure, and you will ultimately see it in tighter lending terms from investors because they want to be compensated for these risks.
Okay, right. So just out of curiosity, David, um, like throughout the history, when do you think these risks have started becoming a major concern for investors? Like, 2000, 2010, when investors started asking this question about climate risk.
Yeah, I mean, to some degree, this has been a material source of risk to companies for decades, and we're just starting to see more frequent examples of this in the past decade, I'd say. So, some very high profile drought incidences, some very high profile wildfire events that have in some cases led to default risk in the last 10 years for utilities. And what that's led to is, increasingly, for example, the credit rating agencies reevaluating the credit ratings that they apply to companies. And we see this filter through to investors as well. A lot more repricing of risk by investors. So I'd say over the last 5 to 10 years, particularly for physical climate risks, but also for transition risks in some sectors such as utilities, transport with the move to electrification, and real estate, where we see investors being a lot more sensitive to green versus fossil fuel intensive assets. There is starting to be signs there of a shift in the last 5 to 10 years, I would say.
I see. So maybe I think after Paris Agreement, things started to shift a bit. Can we say that, or?
Yeah, so we obviously saw governments starting to implement some of the pledges that they made under the Paris Agreement in 2015. There is some good research of impacts in the auto sector, for example, where many regulators, particularly in the European Union, but we've seen this in other regions in APAC, where vehicle emission standards tightened quite significantly as governments came under pressure to align to their pledges under Paris. Obviously, electric vehicles, there was pressure on manufacturers there to increase capex on EVs and make that transition. And for much of the last 10 years, EVs have come with higher production costs than combustion engine vehicles, so that has pressured company margins.
Right.
But generally, we see this to date as being quite restricted to a certain number of sectors. So utilities, where it's been a case of carbon pricing in certain regions, such as the European Union. Transportation, where this has been very much around the shift to electric vehicles, and real estate, where you have particularly tenants becoming a lot more sensitive to energy costs. So they're willing to pay a premium for energy efficient buildings. But equally, there's a penalty for inefficient buildings that have a core dependence on fossil fuels. Because, for example, in commercial real estate, you see many corporate tenants becoming sensitive to the emissions profile of their buildings, the energy consumption there.
Okay, perfect. So moving forward, in your experience, what does integrating natural capital into credit analysis looks like in practice? And how are investors actually measuring and incorporating these risks today?
Yeah, so I think for a long period, natural capital was typically looked at in terms of relative risk scores. So, for example, working with external data vendors to produce aggregated scores of risk or impact on nature, and tie that back to company actions. So in practice, I think this is actually less about producing those aggregated scores of risk and impact, and more about asking targeted questions about your portfolios or your investee companies. So questions like, where does the issuer depend on nature, whether it's biodiversity, land use, water consumption, within its operations or its products? Are these dependencies location specific? So are they tied to a given operating location that could be at risk in the future? For example, if groundwater abstraction goes beyond sustainable levels. And under what conditions could these dependencies become financially material sources of risk?
Mhm.
So the most useful approaches focus on a small number of material dependencies. So starting on the most material sources of risk. Many cases we see water consumption or land use as having the most financially material relevance to companies and
Mhm.
investors, and then testing how environmental shocks such as drought conditions or tightening regulation could impact operating costs or actually impair assets in some cases. So the
Mhm.
industry as a whole is still at a very early stage of translating nature analysis into financial risk. This is an order of magnitude more complex than climate risk, which is already very complex.
Mhm.
So many investors are being quite selective and decision focused, and they see this as being much more effective than trying to look at all nature risks at once. So typically focusing on material sources of risk, engaging companies on those, talking about water, talking about land use, pollutants as the
Mhm.
material sources of risk and focusing there first.
Okay. So, what data, frameworks, or modeling approaches are proving most effective for assessing climate and nature risk in credit markets? Are there any notable gaps in data or methodology?
Yeah, so I think unlike financial data, ESG data is very fragmented. We have very big differences between data providers in terms of opinions or scores on individual companies. We've obviously had the development of common standards and frameworks over the last 10 years, which has been particularly helpful. So the Task Force on Climate-Related Financial Disclosures, which has been in place for just over a decade now, has been very helpful in getting standardized responses on climate risk from companies and looking across your portfolios as an investor. And then more recently, we've had the Task Force on Nature-Related Financial Disclosure, which tries to take the same approach and applies to nature and biodiversity. So frameworks like TCFD and the TNFD can be quite helpful in structuring thinking, standardizing and comparing performance,
Mhm.
particularly taking approaches such as scenario analysis and looking at location-based risks for company
Mhm.
assets. But the challenge that we have here is that in some areas, the reporting expectations of these frameworks are actually running ahead of what companies are practically able to measure without
Mhm.
imposing undue costs.
Okay.
So there occasionally are challenges relating to the relevance of these frameworks across asset classes. So TCFD, for example, has really popularized the idea of climate value at risk. But we do see when we engage with our data vendors that many methodologies such as climate value at risk were actually built for equities, and they don't always map cleanly onto credit instruments. We have to do a lot of additional work to get outputs that look sensible and provide meaningful information to clients. I'd say some of the biggest gaps that we have in relation to data are on the asset level data side. So having a clear view of where companies' assets are located,
Mhm.
whether these are fully owned or whether these are leased, whether these are joint ventures. If it's a mining asset, for example, it's quite common to have joint ventures. Many of our data vendors don't necessarily have that level of granularity. Supply chain visibility is becoming something that's increasingly important. So understanding not just the company's direct suppliers, but far down the supply chain, where could
Mhm.
disruption arise from ESG controversies, from water risk, from other environmental risks. And then the other area is just providing robust links from these environmental hazards into
Risk metric.
financials. So that's why I'm cautious here about false precision. I'd say,
Mhm.
for a lot of these frameworks, there are starting points for engaging with companies, and often it's better to be approximately right about the risk channels than precisely wrong about the number. So qualitative information, asking the right questions of companies can give you a lot more useful outputs than a risk score or a quantitative number.
Mhm. Okay. So, David, you work across fixed income, private credit, infrastructure, and real estate. Do these asset classes approach climate and nature risk differently? If so, how?
Yes, I'd say so largely because the sources of risk can differ, and the control points that you have for managing this risk can differ. And so just given the nature of the assets in public fixed income, for example, this is really a case of disciplined bottom-up research, looking at company level risks, looking at sectoral risks, looking at country and geographical risks and how these interact, and identifying where these risks are truly material to a company's credit profile, where it could actually lead to increased probability of default, then
Mhm.
considering whether we're being compensated for that risk adequately. In private credit, this is actually a bit more complex because there's typically much less public information available. You have weaker disclosure from companies, but you can offset this because we typically have a very strong relationship with those companies. In many cases, we're lending directly to them and we're part of quite a small pool of investors. So you have a stronger relationship with management in many cases, and you have better access to information than, say, a public fixed income investor, which may have many hundreds of thousands of investors. So access to management, drafting of bond covenants and loan covenants can be quite a powerful mechanism there to manage risks. And then moving to infrastructure and real estate, physical climate risks become here very tangible because those assets are location specific. So in contrast to a corporate where they may have many hundreds of operating locations, if one's impaired, that's not the end of the world for their operations. For real estate, this is very much integral to the value of the asset because you're dealing with a single asset in a single location. So a flood event, extreme weather event can really impair the value of that asset and the return to the investor. So this pushes the analysis in real estate towards asset impairment risks, thinking about insurance costs and how these might change over time, capital and operational investment needs over the lifetime of the holding, if it's an equity investment in real estate, and the exit from the investment. So what is the value of that real estate asset likely to look like in 3 or 5 years' time? So the underlying risks for all these assets are similar, but how you manage them really depends on the asset class and some of the specifics of the asset class.
Right. David, out of curiosity, I was just thinking that all the investment which companies are doing, right? What is the probability of success rate? How much do you think are success and how much is failure in all the investment which is going on?
Yeah, so I think in terms of asset classes, we've seen a lot of investment in energy efficiency in real estate because the market rewards that quite clearly because we have common standards. So building energy efficiency standards, building sustainability standards such as BREEAM and LEED. So what's happened there is, particularly in some European, but also some North American and Asian real estate markets, that investors will reward capital investments that are made there in energy efficiency, etc. What's more challenging is on avoided risks, so physical risks, flood damage, extreme weather events, exposure there. That's more challenging because companies that are making those investments typically won't be rewarded because the beneficiary of those investments is not necessarily the end investor. So that's where there'll need to be more work, particularly with the insurance industry in the coming years, so that companies, for example, that are working to try and mitigate physical climate risk can actually benefit from lower insurance premiums. And we can start to get a bit more standardization there of what a good capital investment in physical risk mitigation looks like. It's a lot more challenging.
Right. I think that is the reason why we have more finance flowing into climate mitigation than climate adaptation.
Yes, exactly.
Right. Okay. So moving forward, for boards and CFOs, what are the most important questions to ask their credit teams when it comes to climate and nature risk?
Yeah, so I'd say, given the background that we're in, the boards and CFOs obviously have so many competing demands on their time. ESG and climate risks and nature risks are just one of many myriad considerations that they're having to deal with. So I just keep it practical here, focus in on where could climate and nature risks actually change operating costs or cash flow stability? How could they affect insurance costs, capital investment needs, or refinancing requirements? And where are some of those key time-bound triggers? So, bonds of different maturities, say maturing in 3 or 5 or 10 years' time. What are those refinancing needs likely to look like in the future? And where could some of those ESG risks crystallize and actually impact them? So I think boards in particular are so bombarded with information with regards to ESG that it's really on us as ESG analysts to focus in on what's material to them and provide them clarity on how these risks could impact the cost of capital, could impact access to financing, for example. So I do think ultimately, 5 to 10 years from now, ESG reporting will look very different. I think it will look a lot less exhaustive. It will typically be a lot more short and concise and decision relevant if we're trying to kind of get information to some of those key decision makers who are obviously considering this alongside many other factors.
Right. So are there opportunities for lenders and investors in proactively managing climate and nature risk, or is this just primarily a defensive consideration?
No, I think we do see increasingly ESG sensitive investors looking for strong examples of companies within a given sector that might not be a particularly ESG friendly sector. It might be a particularly fossil fuel intensive sector that are demonstrating good forward ESG momentum. So improvement in their performance over time. So they might not be best in class, but companies that can demonstrate a good forward momentum in terms of their carbon emissions, their water consumption, emissions to land and water, etc. So I think increasingly we will start to see a bit of differentiation there. We'll start to see investors looking for maybe companies that the market hasn't priced in, good measures that they're making. So I think we'll see that particularly on the equity side because there's good opportunities for upsides. Equally, I think we'll see that on the bond side as well. Maybe issuers in some sectors able to benefit from lower refinancing costs if they can demonstrate that they are taking good proactive steps to manage these risks. So they benefit ultimately from making those measures.
Okay. So looking ahead, how do you see regulatory expectations, market pressure, and climate science evolving to shape credit market decision making in the next 5 years?
So one thing I do expect to see is tighter links between physical climate risk, access to insurance. So we're seeing insurance providers increasingly retreating from certain markets in certain geographies that are seen as particularly high risk. So there will need to be work there to ensure continued access to insurance. That could be through collaboration with governments, but also collaboration with companies and investors, all coming together to try and address insurance coverage gaps. And then tighter links between physical climate risk exposure, mitigation actions, and financing flexibility of companies. So that point that I made about companies that are doing good work to try and mitigate these risks, then being compensated by investors through lower refinancing costs. So regulation will continue to raise expectations, but I do think market pressure, particularly around refinancing and insurability, will be equally important. So climate and nature science will keep improving, and the quality of the data, and especially geospatial data and location data, will continue to. But I think the differentiator here will be the institutions that can take this data can actually translate that into relevant issuer level or company level financial insights rather than just abstract analysis or relative risk scores.
Okay. David, just before the final question, I was thinking, for example, I am a startup and I want to raise funding, and you are the investor. I come to you, I show you my business and everything. How would you think about the risk before investing in my business?
Yeah, so I guess the issue that we have with small companies, with startups, companies with lower credit quality that haven't issued debt historically, or maybe haven't even listed as yet, is their room for maneuver is obviously more limited if ESG related controversies happen. Their ability to manage this will be a lot less than a large diversified multinational. So there's something that's is quite important. We do think about this, for example, in high yield companies that are maybe of lower credit quality. So again, their ability to manage ESG risks will be lower. So it is something that startups in particular have to be thinking about. I think what we're seeing in the startup space that is quite exciting is a lot of companies moving into the climate and water solutions space. So moving beyond just thinking about the risk exposure into actually many companies, particularly in the technology space, actually starting to develop solutions. So, startups that can actually offer, large multinationals, water recycling, water metering technologies, extreme weather monitoring, a lot of technology-enabled solutions there that we're starting to see some really interesting startups
I see.
start to tackle. So I think there's opportunities as well as risks.
Right. Like if my company is a technology company which improves the battery efficiency, for example, so you can store that renewable energy before it's transmitted. So
Exactly.
I think that would be a better fit for investors.
Yeah, I mean, it's obviously case by case, but I think we will see over the next 5 to 10 years much more interest in climate solutions and adaptation solutions as well. So companies that can actually offer solutions to some of these challenges, I think we'll have a fairly strong growth trajectory.
I see. Okay, so David, finally, for leaders and investors listening today, what is one practical step they can take to start embedding climate and nature risk into their credit analysis or investment decisions immediately?
Okay, I'd say start small, focus on what's material, make it plausible. So make these risks that are likely to occur over a given time horizon. Pick a portfolio segment where location or climate and nature dependencies really matter. On the natural capital side, for example, you could focus on the top of the food value chain, food retailers, food producers, some of the risks there associated with nature, with access to water, with land use change. So identify some of the key sources of risk, map out how these could impact on revenues or asset values, and then start to embed that thinking directly into existing credit research and documentation. So I think if this changes your view or your decision on a given company or a given asset, then you're doing the work right. If it doesn't, then it probably wasn't a material source of risk as yet, but it's something you should continue to monitor.
Okay. So, David, the last thing is that you are involved with research, right? And with AI coming in, do you think it is the research phase, right? Is it getting more tough because you use AI for that kind of research? How do you think about that?
Yeah, I mean, there's a lot of potential for AI to help improve the quality of ESG data. The challenge that we have as consumers of ESG data is that typically a lot of this is large unstructured data sets that have been pulled together by data vendors in ways that are not very transparent. So we already have some familiarity with trying to scrutinize ESG data as we receive it. That will become obviously more challenging with AI, and there will be an onus on investors in particular to really interrogate the quality of AI-derived data. The other aspect of this is that companies will obviously be relying increasingly on AI data to help report ESG metrics. So again, I think there will be an expectation on investors as consumers of this data to really ask the right questions of companies, to try and make sure that they fully understand the data that goes into an AI model, the data that comes out, and how that reflects ESG reported metrics. So I think a lot of good potential to pull together very disparate data sets and produce kind of views on financial materiality of some of those factors. But equally, a lot of work on our side to be done to really make sure that we have confidence in that data, that what we're getting from companies is reliable and accurate and really reflects those ESG risks on the ground. So obviously, it's evolving very quickly, but something that all ESG analysts need to be cognizant of.
Right. Yeah, I understand. How much confidence do you have on data is a big question, right? Okay.
Yeah, I mean, I think it's something that we've been dealing with in this industry for many years. We do understand the need to interrogate data, to reach out to our data vendors, to reach out to companies, go down to individual data points, and if we think something is inaccurate, to challenge it.
Right. Perfect. So thank you, David, for such a practical and insight conversation today. This discussion is a reminder that climate and nature risk in credit markets are no longer abstract. Financial decisions increasingly depend on understanding how environmental factors can affect creditworthiness, default risk, and broader portfolio performance. For leaders, investors, and risk teams, these risks cannot be treated in isolation. They intersect with strategy, governance, and investment decision making, and understanding how these elements come together is essential for resilient and forward-looking operations. Thank you for joining us on the Climate Leadership Podcast. We will be back soon with more conversation. Until then, take care and have a nice day. Bye-bye.